Ed Gilmer. I'm the Director of Capital Markets for PassiveInvesting.com. And on today's webinar, I'm going over term sheets and what to look out for. There's a lot of intricacies. But before we do that, you can read more about my bio and our team's bio on PassiveInvesting.com and meet the team. I also encourage you to take a look at our current offerings. We have some great investment opportunities right now. One's right north of Myrtle Beach. It's a multifamily deal, brand new build. Love that one. And we're going to get started. So term sheet. So let's go over what is a term sheet. A term sheet's when you find a deal and you nail it on a lender, and they kind of start putting some terms together on paper. It's a lot of bullet points. That can make or break a deal if your debt's right. Even if some of the interest rates and terms are right, but if you have a covenant that's wrong, it can really cost you. I think it's very wise to read these things word for word. And if you're not familiar with them, find somebody else that is. Hopefully we'll learn a little today about term sheets and what I look for. My background was commercial lending before I came over, and now I manage our lender relationships. So a lot of overlap there. Been dealing with term sheets for a long time, and I kind of enjoy it. So the first thing on a term sheet, you're going to have the loan amount. This can be dollar amount. It can be a percentage based on debt yield or the DSC. How much cash flow the property spins off can be the determinant of that. And let me back up one step. All term sheets are different. And specifically for multifamily, whether you're going with a bank, a life insurance company, a debt fund, or an agency product like Fannie, Freddie, or HUD, they're all going to be different. We're going to try to hit a lot of the high points today. And if you have any questions, feel free to put them in the chat box. We'd love to answer those as we go along, so we can kind of keep on topic here. Back to the outline. The first topic is loan amount. One thing I look for is, are all the proceeds coming at closing? Let's say you're buying a $100 million property and you're getting a 70% loan to value. Is that $70 million coming day one at closing? Is it coming $60 million at closing and then $10 million, a year later? Do you have to do some rehab? There's things called earnouts. We're going to go over those later. Is there any construction? Do you need to do any repairs? Sometimes lenders will say, put a roof on, do these rehabs, we'll get you the additional funds. So the first thing I look out for on term sheets is how are the funds coming and the timing of that. Obviously, the more proceeds you get up front, the better. I like it. The second thing on loan amount is it determined by a debt yield or DSC test? In this market we're in now, a lot of our multifamily deals are DSC constrained, meaning the net income of the property dictates how much loan you're going to get. Thankfully, all our properties cash flow very well, and that's not an issue. But with cap rates compressing, property values increasing, a lot of loans are constrained by DSC. The agencies, Freddie Mac, Fannie Mae, and kind of HUD's kind of in that mix as well. They look for a 117 to a 125 debt service coverage. So just take your NOI, divide by 1.25 or so. That's kind of a starting point. Banks, life companies, and debt funds look for a 120 to a 130 coverage. And that can be off of today's numbers. And if you have a property that's leasing up, a newer property, you can kind of look forward a little bit until some of those proceeds are more realized, more stabilized. The next thing I look for on a term sheet, when you have a deal with multiple people, multiple investors, who are the guarantors? Is it just you? Is it a company guarantor? Is it a full, a partial, or limited guarantee? This only comes into play when a lot of people like no guarantees. Most multifamily debt in my experience, is not personally guaranteed. There are corporate guarantees, whereas if you don't pay it, they get the property back, but not personal guarantees. In my theory, if you're going to pay for it, it doesn't matter who guarantees it, right? This only comes into play if you don't pay for it. There is the way some term sheets are set up, you have what's called a burn-off guarantee. So once the property, 12 months down the road, 24 months down the road, once the property hits certain debt service coverages or different debt yields, the guarantee can drop off. With a partial guarantee, let's just say you do 50% guarantee. If you're doing a $50 million loan, 50% guarantee, $45 million. The lesser debt you have that shows up on your credit report, a lot of people like that better. It's cleaner. And limited guarantees, meaning if you had, let's just say 10 partners on a $100 million debt, it'd be $10 million a piece, kind of pro rata. And depends on the lender. A lot of banks do full guarantees. And this is what they do. It's kind of how they operate. Debt funds, life insurance companies, and agencies tend to not care as much about personal guarantees. That's why people like those. A lot of times are better rates, better terms on multifamily properties than your traditional banks for larger properties. The next point is interest rate. In the market we're in right now, rates are climbing fairly quickly. We're still historically pretty low. But what I look for, the first thing on rate is it a fixed rate or is it a floating rate? And then the term, is it fixed rate for 5 years? Is it fixed for 3 years? Some debt funds and life insurance companies do like bridge loans. So there'd be a 3-1-1 where you'd have a rate fixed for 3 years and then an option for another year and an option for another year. And those rates would be determined after the initial 3-year period. I like long-term debt, and ideally we'd have all long-term fixed rate debt at low rates. But given where the market's going, I think rates will come up a little bit higher and then kind of drop off into the latter part of 23 and 24 and 25 going forward. So just be careful with that on the deals you're looking at. I know we are. The next thing I look for on interest rate is the basis. What is it based on? If it's a fixed rate, it doesn't really matter. 6%, 5% fixed for 5 years, pretty straightforward. If it's a floating rate, you need to know, is it tied to Wall Street Journal prime rate? Is it tied to SOFR, SOFR? It's kind of, SOFR has replaced LIBOR as the industry standard for floating rates. You can find all these rates online. There's a few different websites you can look. I like SOFR as a basis. Right now, it's a little above 3%. So the way that would be structured, a lender would say, your terms are SOFR plus 2.5%, SOFR plus 2.25%. So let's just call SOFR 3% right now. So SOFR plus 2.5 would be 5.5% as of today. And depends on the term sheet. If that adjusts monthly, daily, quarterly, annually, most of them adjust daily. And then once a month, whatever the rate is that day, your interest payment would be based on that. There's also minimums. The most of the terms I've seen recently, when lenders put their term sheet out there, the starting rate, the basis, is kind of the floor. So let's just say if SOFR is 3% with a 2.5% spread, so 5.5 total, the lender would say the loan is based on SOFR floating with a 3% floor. So if rates went down, if SOFR went down to 1%, you're still paying, the full 5.5. So I'll let you negotiate that down as much as possible, especially when rates are, higher than I expect them to be the next 3 to 5 years. When they come down, I think those savings should be passed on to investors. That's something I look for. The next point on term sheets is, well, let me take a break. there's any questions, feel free to raise your hand or drop them in the chat. I want to make sure we address these as we go forward, not wait till the end to kind of come back if we can here. The next point I'll look for on term sheets is fees. What kind of fees are involved? There can be some big numbers, especially when you're dealing with loans in the 25, 50, $100 million range. Is it a 1% origination fee? So if you had a $100 million loan, 1% fee, that's $1 million. It's pretty hefty. Generally, origination fees on smaller loans, below $20 million are, half a point to 1% fee. Once you get above $20 million or so, those fees tend to compress to a quarter point, half a point. I mean, half a point on a $100 million loan is still $500,000. This is one area I like to push back on pretty hard. Most lenders I found are flexible with a fee more than a rate. Their credit team might say you have to have this rate, have to have a spread, but let them cut the fee a little bit. And if you can save, $50,000, $100,000 up front, why not, right? It never hurts to ask, at least. Other fees are, is there an underwriting fee, an application fee, loan document fees? Do any of these go towards a purchase price? So sometimes you have to put a good faith deposit down. Once you sign a term sheet, you wire in a certain number of fees up front just to kind of commit to it. And one of the questions I always ask and verify is, are the fees going towards the purchase price or the deal, or are these cost? If you're doing a construction loan, those origination fees tend to be in the 1% range. That's is what it is. There's a lot more admin and lending cost on a construction loan. Again, try to negotiate. Why not, right? But like I said, I look for fees in the 0.25 to 0.5% range on multifamily deals, and I try to negotiate those on every deal. The next point would be repayment terms. On a high level, is it interest only loan or is it amortizing? Most investors prefer interest only because if you don't have to pay it back, why not? Your cash flow is better with interest only. Depending on your lender, banks prefer amortizing loans or loans that pay back. They like to get the money back. Debt funds and life insurance companies are more open to interest only loans. And then the agency loans, Freddie and Fannie, and HUD as well, can be mixed. Depends on the deal. They can do interest only. They can do amortizing. The term of the loan is another big one. Are your payments, if they're amortizing, are your payments based on 15 years, 20 years, 25 years, 30 years, or in some cases, some HUD lenders can go up to 35-year amortization, which the longer the AM, the lower your payment is. So, but on some level, you're just paying too much interest. It's like a residential mortgage. A 30-year, you can pay a lot of interest. 15-year, not as much, but your cash flow is better. So you got to find what points you like and work with the lender on those. The next point under repayment would be, are taxes, insurance, and reserves escrowed? Are you paying 1/12 of your taxes and insurance per month to the lender, or are you saving for those yourself? Additionally, reserves. A lot of lenders, they say certain number of dollars per unit per year in reserves. That number is usually in the $250 range. So if you have a property with 100 units, $250 is $25,000 a year. So you need to make sure that those numbers are in your budget. The lender would take those reserves and set them aside, of course, for if and when you had repairs. Well, I'd say when you have repairs, you will. The next point, pretty big one here, is the prepayment penalty. is there a fee for paying the loan off, after 1 year, 2 years, 5 years? These tend to line up with the term. So if you have a 5-year loan, most prepayment penalties will be 5% year one, 4% year two, 3% year three, 2 and 1. I like to negotiate these as well. You don't know what's going to happen in 3 years, 5 years. So if we can get a 5-year loan with only 1 or 2 years of prepayment penalties, and markets do really well the next 3 years, we could sell it without paying a fee. Some lenders have exit fees, meaning no matter when you sell the property or refi, they're getting a fee. So I don't like those. I'm not a big fan of fees in general. So I always try to negotiate those down or completely out of the picture. Let's see here. Christian has a question. Why would most investors prefer interest only other than max cash flow? They are less secure in the property, higher payoff for the balloon note, and aren't building any equity. Let me kind of break that down. Why would most investors prefer interest only other than max cash flow? If you're assuming a market with steady appreciation, which in the last few years has been kind of crazy, and we may be, and who knows where appreciation is going in the future. But if you assume 4 or 5% of your appreciation steady, and you're only paying interest on this amount, then your equity grows with time at less of an expense. I wouldn't say it makes the property less secure. And interest only loans, you're getting 60, 65, 70% loan to value. So there's still a lot of equity in the property up front. And the payoff is just the principal. With an amortizing loan, you're slowly paying back over time. The banks like those; they're less risky for them, they feel like. But paying principal back is taking money from your cash flow and putting it over here, the property. So you're not creating any additional equity; it's just transfer of equity. So, in my opinion, if you can have your payments every month be lower, you're making more money. Some people prefer amortizing. If you're, your goal is to own a property for 30 years and pay it off, for 20 years and pay it off, that's a different answer. Most multifamily investors, in my experience, are kind of more in the 5, 7, 10-year time frames. And when you're talking those time frames, I think interest only tends to work better. We look at both on every deal, to be honest with you. So I tell lenders or brokers, whoever we work with, hey, show me some interest only options, show me some amortizing options, and we underwrite both to see which ones work better. Obviously, interest only cash flow is better. So, but good question. Feel free to follow up if I didn't quite answer your question there. I think I kind of addressed the prepayment there. Another thing on prepayment is, so there's a step down prepay. That's what I mentioned. It was like a 5, 4, 3, 2, 1 for a 5-year term. There's a flat prepay. You don't see much of these. That'd be like, for a 5-year loan, that'd be like 5%, 5%, 5% every year. And the only time, a lot of times lenders will waive prepayment penalties if you refinance with them. You don't want to be handcuffed to a lender in case something goes wrong. You want the ability to move around if you have to. And there's plenty of times that we look at refinancing with this current lender. In most cases, things are going well, not a problem, but you don't want to be obligated to. And again, the prepay is where I've found a little bit of success as well, negotiating off the last couple of years. So let's say if we did a 7-year loan, instead of a 7% penalty year one, 6% penalty year two, down to 1, maybe they do a 5, 4, 3, 2, 1. So after 5 years, there's no fee. So at least getting you a little bit of flexibility on the back end. I think lenders are more open to that, as long as they get, the purpose of a prepayment penalty is so they get their a certain amount of interest for the first, 3 years, 5 years, 7 years, whatever it is. And they're kind of underwriting to those returns. So they want to make deals that make sense for them too. Another point, we got a couple more bullet points here, but I would encourage people not to beat up a lender on every single bullet point. I was in lending for a while, and I like it when a customer has, one or two hot button issues. Maybe it's the origination fee needs to be lower. Maybe the repayment needs to be, 20 years, 25 years instead of 15. But if you're one of these people that's beating the lender up on every single term, every single deal, the relationships are going to suffer. We're in a relationship business. I'm a big proponent of that. And, the people doing these loans are in the business of making money too. They have to hit their targets and the numbers. We want to do the best deals we can for our investors and ourselves as well. But at the same time, you don't want to destroy a relationship or a deal over, a few cents, a few dollars, or, 0.1% of a fee here and there. So just be smart about it. But it never hurts to ask. We'll come back to that. I push a little harder than most people do on getting the right terms for us. So the last couple of points I have here, and then again, feel free to ask any questions if they come up, would be covenants. So covenants are kind of towards the end of a term sheet. And this is where it gets interesting. These are just bullet points, 1, 2, 3, 4, 5, 6, 7. Banks can put, or lenders can put whatever they want in there. Maybe you have to have a minimum net worth. Maybe you have to show them annual tax returns. Maybe you have to show them quarterly profit and loss statements on the property. Sometimes there's certain DSC coverage tests. If the property falls below a 125 DSC, it would be in default. Sometimes there's DSC tests. They'll send you sheets every month, every quarter. You have to fill out, hey, here's my NOI. Here's our, fees. Here's the debt service coverage. And then sign them. How often those are required. Does the lender require any reserves? Kind of addressed that earlier. And if they do, are they going to hold them? Are you getting interest on those? Let's see. Do we have a Q&A here? Let me click over there. All right. Alicia Jones says, I have a mixed use new construction development, 190 apartments, etc. Our term sheet is from a venture capitalist at 100%. Is that what you mean by agency? No. 100% debt. That's interesting. I'm sure you love that. It's probably a pretty high rate there, but agency would be Freddie Mac or Fannie Mae. It's kind of a quasi-government backed loan. Those are more, that deal might work if the multifamily piece is just broken out. And you can do, 5 years or 7 years, 10-year deals with agencies, 25, 30-year amortizations, if not interest only. But no, a VC, a venture capitalist, that's just a private lender. So I would be curious to see terms on that if you want to share those in the Q&A. So 100% loan is there's pros and cons to it. Obviously no equity in, but I'm sure they're getting a piece of the deal too. So probably a pretty good return. The last thing on term sheets I would look for is the date. What date? Excuse me 1 second here. I gotta sneeze. All right, excuse me. The last thing I look for on a term sheet is the date. How long is the term sheet good for? They'll say, we're giving you a rate of 5% fixed, 5-year balloon based on a 30-year amortization. This rate is good for 45 days. Maybe this loan must close within 60 days of the term sheet. There's a little bit of flexibility there. If something were to happen, you're able to push into 61 days, 62 days. But I'll look for those, and that's something you want to try to get right on the front end. I mean, if you know it's going to take you 90 days to close on a property, and the term sheet says 45 days, go ahead and address that. It's a lot easier to do that up front. The other thing is rate lock dates. How long is that rate good for? In the market we're in now, rates change daily, a lot daily. And thankfully, the last couple of days, the treasuries are coming down. So when does your rate lock? How long is that rate lock good for? And another kind of side point there is there what's called a float down option? So let's say the 10-year treasury was like, I forget exactly where it was, but it was around, let me pull it up here. It's around 3.5%, 3.6%. If that's, something happens that drops to 3% during the time between your contract and when you close the property, will your loan interest rate go down? Obviously the lender would prefer not to, you prefer it to. That's called a float down option. I always look for that. Lenders don't like to put that in there. The flip side is when you sign a term sheet, try to time it so that the treasuries or SOFR or whatever it is kind of down that day. We had a Fed announcement last week. Rates spiked Wednesday, Thursday, Friday, and then Monday and today, the treasuries are coming down a lot. So if you have a deal, kind of wait day by day. You have to go based on your feeling, based on what you think rates are going to do. I had a feeling rates were going to come back down after the spike last week, and thankfully we're right. So you have to time that. A lot of times, once you sign the term sheet that day, your rate's kind of set on a fixed rate deal. And the last one is days to close. Like I said, is it 90 days to close, 120, 60 days, 30 days, 45 days. And those are kind of the bullet points I look for on term sheets. Feel free to pop any questions in the Q&A or the chat. Let's see. Vincent has a question. What's the best way to find a partner to obtain an agency loan? There's two ways to do agency loans. One is to go direct. Those are usually for larger, more experienced borrowers. The other way is to use a broker. There's a lot of lenders in our area, in the Southeast in general, in the whole country, that do Fannie Mae and Freddie Mac loans as well as HUD loans. Anybody can do that. A lot of people can do those. I would pick a lender on that based on relationship. If you have a debt broker you use or someone that you know of, I would start with them and see if they're an agency lender. I can recommend a couple if you want to email me. My email is ed@passiveinvesting.com. Happy to try to help out there. We have some great relationships, and I'd love to share those with you. They're kind of all getting the same product. It's based on the relationship and how hard they're going to work for you. So, all right. Harsh has a question. I believe I met you in Charlotte. Why do we hear of stories of lenders changing the rate or terms in the last moment? How can we avoid that? Great question. Given where we are in the market and with rates being so volatile the last 6 to 8 months, that kind of boils down to experience and relationship. I'd work with a lender that you trust, that you know is going to hold the rate. There's been more of that recently with these quick rate hikes. If you get a term sheet, 3 months ago that was 4.5% fixed, and the lender's cost of funds go up during the deal to where they're losing money, they may come back with a higher rate with you. But once you have a lender you work with a few times, I think you trust them, they're going to stick to the word. And if they don't use them again. But that's where the term sheet says, this rate is good for 60 days, 90 days. So I would try to make those terms in the term sheet. And if you have any questions, I would have an attorney review any of this stuff, just to make sure you're getting the right deal. And if there's any questions that come up like that. Ken has a question. Isn't it annoying to keep refinancing every 5 or 7 years for someone who wants to keep the property for longer than 10 years? Are there some loans with no balloon, but rather completely amortized in 24 or 30? The longest I've seen is 10 years. And that's more, so on your 30-year fix, that's more residential, single family house up to 4 units. You can do that. I'm sure most of us have a 30-year fixed rate, 15-year fixed rate. The debt for that's different. Lenders don't want to do multifamily deals, which tend to be a lot higher dollar amounts over 30 years, because who knows what rates are going to be next year, much less 30 years down the road. So if you are looking for a 25 or 30-year hold, I would probably do a 10-year deal. And that's either going to be Freddie Mac or Fannie Mae. Let's see. Vincent has a follow-up. I have 15 years experience, but not in true commercial. Agency wants 5% of experience, 5 years experience. I need a partner with 5 years experience. So there you go. Somebody wants to connect with him there. Harsh says, is the term sheet binding? They're not. That's the funny thing. It's kind of like a LOI, a letter of intent. It's kind of both parties coming to terms. But at the end of the day, if the lender don't want to do the deal, they're going to find a way out, right? That's where it comes back to experience and relationships and working with people you trust and know we're going to make it happen. So lenders usually have an out, but let's see here. Ed, type your email address here. All right, let me. There you go. Go back up here. Let's see. Blake has a question. What liquidity requirements are you seeing now for guarantors and for liquidity requirements for borrowing entities and or historically? I don't think this has changed very much. It's either in the term sheet, it'll say a percentage of the deal. Maybe we need 5% liquidity, 10% liquidity. Those have been pretty standard numbers for as long as I've been around. And that's more like checking a box. Either you have it, you don't have it. And if you don't have it, find somebody that does, or negotiate the term down. Let's see here. Chad says some insurance companies will do a fully amortizing loan out to 20-25 years, but at a low LTV. It's a good point. Yeah, I mean, if you're doing something at a 40% loan to value, you can be a lot more flexible. But that's putting a lot of money in, tying your money up for 20 or 25 years. Depends on your kind of investment objectives, but that I guess is a possibility. There's some that work around 5 years experience with agencies. Let's see. Nate Dempster says, what type of institution should we seek for a new multifamily development loan? Depends on the size. If you're doing a deal in the $5, $10, $15 million range, I would start with a community bank, a regional bank. If you're doing something in the $20 to $100 million range, that's going to be your larger lenders, your debt fund, life insurance companies. I would find a good debt broker if you don't have a good relationship already, to try to find you the best deal. They advocate on your behalf. They charge a fee too, but that can save you a lot of money having a great debt broker. So Ken says, do lenders check resume of guarantor only, or do they check resume of the whole general partners team? Deal finder, underwriter, etc. Depends on who your general partners are. They do background checks. They do credit checks. And I think that it is kind of a resume check. They're going to do their homework. If somebody's loaning you, $30, $40, $50 million, they're going to do the homework on you. The only time a lot of these deals do have personal guarantees is called a bad boy carve out. That's if somebody's committed some kind of crime or fraud or misrepresentation. And in those cases, they can come back and personally go after you for the deals. So again, hopefully it never happens to any of you or any of us. But it's called a bad boy carve out. That's saying no personal guarantees unless you do something completely illegal. All right. Well, again, if there's any more questions, feel free to pop them in here. We're about to wrap it up, but don't forget about the Multifamily Investor Nation webinar. Website is MF Multifamily, MFINCON.com. And we're going to have Alex Rodriguez there next year. Huge speaker. He has a portfolio of $700 million of properties and 13,000 doors. Pretty massive. So let's see. Harsh as a follow-up. Any resources to understand debt and private equity space outside of real estate? That's kind of a broad question. I guess you're kind of getting some venture capitalists there, some investment type stuff. I would just network with some investors, some private equity folks that invest in not real estate. Obviously, all we do is real estate. My experience has kind of mostly been real estate based, so don't have a great answer for you there. Apologize for that one. So, all right. Well, if there's not any more questions, we're gonna wrap it up. Thanks everybody for the time today, and look forward to seeing you next week. See you.